and your life.
Hello, everyone. My name is Owais Siddiqui. I work as a country manager at one of the strategic arms of Islamic Development Bank. I'm a teacher and trainer of financial risk management. I have been doing it for more than a decade now. Um, as you know, there has been a lot of topic in the GES summit. So risk management is more towards a bit of technical side. Most of the topics that I have been seeing through are more towards the softer side. So it would be I believe it would be a good addition in the overall summit. So just to explain you a little what financial risk management is. So uh, basically it's a discipline which evolved from finance. So it used to be part of the broader finance department of organizations, but as things grew, as things became more pertinent, as people started realizing that other than the finance, there has to be department, there has to be someone who takes care of the risk of the institution. Uh, so the risk would be broadly of two types: financial and non-financial. Today we'll be talking more about the financial risk, because at the end of the day, it all comes down to bottom line or profitability of the company. So if you have a lot of risk, but it's not turning out to be disastrous for the bottom line, for the profitability, or for the reputation, it doesn't harm companies that much. But if it's a risk which can hit you hard and which can impact your profitability, it's something that's going to impact to the organization. Financial risk management is a discipline which is more sophisticated, more developed for the financial sector as of now. Let's talk about a large bank or insurance companies, but it is something that is also adopted for non-financial companies as well. Even I have seen its implementation for startups and small businesses as well. We did a session a few weeks back where I talked about the implementation of financial risk management in the startup or a small business setup. So the concept, the broader range of the concepts remains same, but you do things at a more granular level for business and startup. So let's start the session formally, and first let's talk about what is risk. So as we all know, risk is uncertainty. Risk is something that is relevant to our own life. That's something that we keep on listening about, and it is just uncertainty surrounding outcomes. If you are going outside, you have a risk of getting hit by a car. You may have an accident. So you take precautions, you take measures that you don't get that accident. You have, the signals on the road. There is a sergeant standing there who's making sure that traffic is going with the flow, and you have your seatbelt on. You're following the traffic rules just to make sure that you avoid any sort of risk which may impact of course your life or your car, both financial and non-financial. So when talk about this concept of risk in the financial world, it becomes about the profitability. Okay, so when we talk about uncertainty can go both positive and it can both go negative. But as an investor, let's assume a person who has invested in the stock market. So the stock market can go up, the stock market can go down. So if I, as a company, if I have invested $1 million in S&P or in Shanghai Stock Exchange, there's a possibility that after a month, my investment can go up to $1.1 million, or it can go down to $0.9 million. But as an investor, I would be very happy if my investment goes up to $1.1 million, and I wouldn't be concerned about it. But I would be concerned about what if it goes down to $0.9 million, or it may go down to 0.8 or 0.7 or 0.6 or 0.5. So I would be concerned about what losses can I book on a particular investment. So the investors would be concerned about the negative risk, about the losses that we may bear on our investment, on our operations, on our financings, on our on our reputation. So there may be a lot of options, a lot of dynamics on that particular risk. But yet again, whenever you talk about risk, you talk about the downside risk, not the upside risk. So having said that, the risk is uncertainty, it's the volatility, it's uh, that phenomena that would allow you to not achieve your objectives. Let it be the objective of profitability, let it be the objective of meeting a certain number of customers, let it be an objective of any financial non-financial concerns. So the concept of risk is broadly pretty much similar to what we take in our life, but it's more financial in nature, where your bottom line, your profitability gets impacted. So that's the first thing. The second thing is, which you must have heard of. It's a jargon that we use in finance or financial risk management, which says that higher the risk, higher the return. So as we know that there's a trade-off between risk and return. If you have to achieve higher risk, you will have to take more. If you have to achieve more returns, you will have to take more risk. One simple example is investment in equity market and investment in bond market. So the bond market, even especially the government bond market, it's very less risky. You don't have to face a lot of risk there, but the returns are also on the lower side. But if you go and you invest in the equity market, the risk is higher, the volatility is higher. You don't know that what would your investment be in next 1 month, in next 1 year, because there is a lot of volatility over there. The equity index moves up, it goes down. That the volatility keeps happening. So if you are willing to take more risk, if you are going into an area where you are uncertain about the results, that's when you can get more results. So if you're getting a return of, let's say, 2% in the fixed income market, you can get a return of, let's say, 8% of in the equity market. And that 2%, that 6%, 8% minus 2% is actually what the risk premium. It's the risk is the return that I get through getting more risk. Now let's come to the part. So as we have understood what risk is, let's talk about what and why financial risk management. So what I have told you already about what is financial risk management. Let me tell you why financial risk management is absolutely critical. So I have been working with risk management for about 12 years, and let's add 4 years of my bachelor's study, which was also in risk management. So I have almost 16 years experience in risk management. And one thing that I can say for sure is risk management is all about sustainability of the organization. Basically, what I've experienced in my life is nobody likes risk management in the organization, because risk management would be the people who would tell you to seek out risk, to take precautions, to don't invest a lot in that organizations in that sector. So risk management would also always be about reporting something, about restricting people from taking risk. But we do it as a risk manager to ensure that the organization is sustainable, to ensure that the organization can bear the losses, to ensure that no matter how much loss we bear, we still have the capacity, we still have the buffers to bear that loss, so that we remain operational, we don't go bankrupt. So it doesn't matter if you are a large corporate, it doesn't matter if you are a financial institution, it doesn't matter if you are a non-financial institution, it doesn't matter if you're just a new startup or a small business. Sustainability is a key. And if you want to make your business sustainable, you will have to seriously think about imposing effective and efficient risk management measures. So that's my philosophy of risk management. There are risk professionals who talk about it differently, who take it differently. As of now, risk management is more of a regulatory thing. So most of the organization do financial risk management because the regulator, because the central bank, because the Security Exchange Commission ask them to implement those functions, to implement those risk measures, to implement those systems. And that's why I do that, unfortunately. But it is something that should ideally be avoided, adopted, which shouldn't be just to fulfill that regulatory requirement. So, so as we have discussed why we need to know about financial risk management, let me give you a basic terminology. Broadly speaking, again, industry-wise, financial risk management is something which is more related to the financial institutions, the banks, the insurance company, the hedge funds, the asset management companies, because in the financial institutions is all about the financials. Okay, so broadly speaking, financial institutions talk about financial risk management. And there's the concept of enterprise risk management, which is also adopted in some of the financial institutions. Well, it's not that enterprise risk management is alien to the financial institutions. They also call it enterprise management in some of the jurisdictions. But broadly speaking, enterprise risk management is a concept that is related to non-financial companies. Especially things like, what happened in the last couple of years, the disruptions that we faced, the companies faced, the organization faced, the criticality and the importance of this enterprise risk management have increased exponentially. So the firms which did not used to have an enterprise risk management department, they are developing one. The companies which used to have a financial risk management department, they are further, enhancing it, further enriching it, further hiring more resources to make it more efficient to be able to weather such risk. So this is where financial risk management is. Now, let's talk about what kind of risk do we face in the financial and the non-financial market. So there are a lot of risk. We can go and easily translate 10, 15 risk, like broad risk, and the broader risk can have different, risk further subtypes. But let's stick to the major risk that an organization faces. And the first one is the market risk. Market risk is basically whenever you are investing in the market. I give you the example of investing in the equity market, investing in the fixed income market. So whenever you are investing in the financial market, you are investing in equity market, you are investing in the bond market, you are investing in the currency market, you are investing in the commodity market, there's a chance that the prices, the levels of those companies goes down. So if you had invested, as I gave you an example, if you have invested $1 million today, it may happen that the market goes down and you lose your investment and it goes down to $0.8 million. There is a possibility that you have invested in the commodity market, you have purchased oil futures, and the prices of oil goes down. Oil is at a higher level during these days. It's still going down, but it's still strong at around $80 per barrel. But I'm just giving you an example that if you have invested in the commodity market, there is a possibility, there is a risk that the commodity prices go down. And if you have invested again in the commodity at $1 million, there's a possibility that it goes down to $0.8 million, $0.7 million, largely because of the change in commodity prices. So you have, let's say, purchased $100 and the price of oil was, let's say, $80 per barrel at a time, and your invested moves up to let's say $80 million. Okay, but the prices moves down from, there's some dispute between the major oil producers, and the price goes down from $80 per barrel to $60 per barrel in a matter of 1 week. Then you would definitely be losing around $20 million in that position alone. So market risk, again, it's the risk that you have invested in the market and the market will go down. The second risk is the credit risk. So if you talk about the financial institutions, the critical role of financial institution is to give money. So what they do, that they take your money, they pay you an interest of 2%. They lend the same money to another corporate or individual, and they take an interest of 6% from them, and they keep a spread of 4%. They around 2%, 1 to 2% of those spread goes to operations of the institution, and 2% remains as a profit. So when the major business of a company is to lend money, there's a possibility that the party that you have lent to goes default, it doesn't pay the money back. So for example, you have given financing to an oil company, and the oil market goes down and the company goes bankrupt. So if you had given them $5 million, you would be losing that $5 million because of the market crash. So this is what we refer as credit risk. Credit risk is, simply speaking, it's a risk that you have given money to someone and they don't return back due to any reason. they may have the they may have the needs, but they are not just willing to give it back. So so that also happens. So credit risk is a risk that the company may suffer if counterparty fails to meet its contractual obligations. Then operation risk is probably the most dynamic, most diverse risk that we may face in an organization. Operation risk is a risk which comes from a number of things. Number one, it may come from internal processes. Processes is, again, it's a very broad thing. Doing a transaction is a process. Hiring a person is a process. Doing regulatory reporting is a process. So any issue, any failure, any inadequacy in any of the process can bring operation risk. Then due to human error, so you did not have any willingness to do any error, to do any fraud, but you just did it as you're a human at the end of the day. So human error is actually a part of operations. Then there can be external event. There can be a person who defraud you, who takes money out and shows you fake financial reports and just take your money and moves away. So that's part of operation risk. So operation risk is probably the most critical risk in an organization, and is the most diverse one. Then we have business risk. So business risk talks about the variability in the inputs that goes. So what is the customer demand trends? What is the product pricing? What is the cost structure? So if your business isn't going well, if you aren't taking enough decisions, if your decision making is not good, if you are having shipping delays, if you are having production cost overruns, this is the kind of risk that you may face for your organization, and you may be bearing losses. The second risk is pretty much similar to business risk, but it's more of a long-term thing. So if you're having businesses would be about the day-to-day operations, and strategic risk would be a long-term thing. For example, you decided to invest in, let's say, XYZ country. So you are operating from Malaysia, and you thought that maybe you should also, diversify your operations and open an outlet in Thailand. So what happens? Your strategy may not be right. So maybe the product had a demand in Malaysia, but it doesn't have the demand or that sort of demand in Thailand. So you had all sort of expansion. You put a lot of money, you invested a lot of things, you built the team, you went through all the regulatory requirements, but at the end of the day, you were not able to achieve this strategic objective that you identified while diversifying. So that's the strategy risk. The problem with this strategy is that when you're making sure that you do all sort of analysis, your strategy is solid, tight, packed. There isn't any issue with your strategy. You have done your feasibility, you have visited the market, you have met people, you have seen other businesses growing, you have your financial model, you have your non-financial model, everything is planned. But once you go operational, only then you will realize that there was some strategy that's involved. So there are ways of how you can identify and how you can avoid the strategic risk. But strategic risk is the risk which may dent the reputation of the organization, and it may eat up your equity pretty quicker than any other risk. Then the next is reputational risk. Reputational risk is the risk which is key to a lot of organizations, especially if you're dealing with the public. If you have you are running an e-commerce store, or you have a business which goes out in public. So if there's any social media riot, if there's any reviews that dent your reputation, that's one thing that you have to care about. The problem with reputation is that you cannot quantify reputation. So you may know that this is a risk that we may face, but you cannot just know what sort of impact you can have through this particular risk. So it may come from two broad categories. It would come as a loss of confidence in the firm's financial soundness, or it may be a perception of a lack of fair dealing with stakeholders. So these 6 risks, these are broad risks that we have just tried to cover to just give you some flavor about what risk management is. Now move forward and let's talk about some of the practicalities, some of the implementable things of risk management. And the first thing is the risk management strategy. There's one thing for sure about the risk is that you cannot just, nullify your risk. It cannot happen and that you do something and your risk just goes away. Okay, it will always remain there. So there are broadly four strategies that we can do about risk. The first one is accepting the risk. Okay, so you know that you are investing in the equity market and you know there is certain volatility involved in the equity market, but you still invest. And you say that I know that there is a less involved in the equity market, but on the other hand, I am also getting the money out of it. So the return that I am getting from investing in the equity market, the return is good enough, and maybe I can accept that sort of risk that comes with it. So that's one thing. You just accept the risk. You say that yes, I know the risk is there, but it's also providing me the opportunity to get more return. So the first strategy, which can be adopted by organizations, is to just accept the risk. The second one is the opposite of accepting the risk, and it's the avoidance of risk. So you know that there's volatility in the equity market, and you say, instead of accepting the risk, you say that I will avoid it. I won't go into the equity market altogether. I'll invest it somewhere, but I won't just invest in the equity market because I cannot bear that sort of volatility. And that's one of the approaches that is just adopt. Yet again, avoiding equity market is a very broad example. Organizations usually don't do that, but they may do that at a sector level, at a company level. So they may know that there's a sector which is, like, for example, a commodity sector. They know that commodity market is very volatile. It keeps on hitting you hard whenever you think that it's working well. So the company may decide to, yes, we will invest in the equity market, but we will not invest in the commodity sector or in the manufacturing sector or in the textile sector, whatever sector they feel is risky. Then there is third thing, which is mitigating the risk. Through mitigation, is that I'm just trying to do something which would minimize the risk if that happens. For example, if I am given money to a borrower, I face this risk of him getting out without paying the money. That was the credit risk that we just earlier discussed. What I can do to mitigate the risk, that I will ask him that, okay, I've given you a financing of $1 million, but you need to pay me a property which would worth at least $0.8 million or $1.1 million or $1 million, whatever your strategy is. So once you have that papers, once you have the mortgage papers, the mortgage on your name, you know that even if he goes default, I'll be selling the mortgage and I'll be able to recover some of my losses. Obviously, this is all litigation, this is all legalities, but the legalities, the rules and regulations allow you to do that. You may also ask for just gold. So I'm giving you, gold is usually used for individual transactions when you're lending money, like $10,000, $1,00,000. That's when you can ask, I'm giving you a $10,000 cash, but you should be giving me jewelry at gold, which would be equal to that amount. So this is something that is used in some of the informal sector, mostly, like in the microfinance sector, maybe. So that's one way of mitigating the risk. Then we have another thing which we call it transferring the risk. So transferring the risk is probably the earliest form of risk management. If we go back to history and we see that where the risk management started, we would see that it was actually the merchants which used to have some security pool. So all of the merchants used to pull in some money and they used to keep it in a safe place. So what if any merchant get losses, that will be covered through that pool. So one of the examples of transferring the risk is insurance policy. So that the cargo is coming, or you have your cash in your vaults, or there's a risk of theft or robbery. You would just transfer that risk to an insurance company. You will pay them the insurance, and they will pay you the money if certain events happen. Okay, so acceptance, avoidance, mitigation, and transferring of the risk are broad four strategies of risk management. Now let's talk about risk management process. Again, this is a broad journal aspect of risk management process, but this is equally implementable as well. So if you talk about any risk management program, it will be revolving around these things. So the first step that we need to do is risk identification. So remember, you cannot implement a risk management policy if you don't know your risk. Unless you don't know your risk, you won't be able to manage them. Simple. Or if you, for example, you had done a risk identification and you identified 10 very critical risks, but there was one risk which was ignored, which was not able to become part of that risk, that list of risks that you identified. That risk wouldn't be managed. Okay, so the first and the most critical aspect of risk identification is to identify a list of risks that company may face. Now there are a number of strategies that can be adopted. Brainstorming is one session. You call different senior professionals from your organization and you ask them that what sort of risk our company may be facing. You may take interviews. You go to them individually and ask them questions like what are the risks that you face in your day-to-day job and how we can manage it. Then there is last and probably the most critical example of risk identification, and that is to identify all sort of process a company has and then use those processes to identify risk. This is an example that we'll just shortly cover. I have mentioned a tool which is called risk control matrix or risk register that we'll just shortly discuss. That's an area that you can also seek. So the first step is risk identification. Then the second step is risk assessment. And risk assessment broadly has two parts: risk analysis and risk evaluation. So risk analysis, we talk about risk analysis, which is the second portion. We try to develop the understanding of the risk. Okay. So basically, why we try to do that? We try to do that so we may implement relevant risk management strategies. The risk management, remember we talk about processes and we are talking about the risk. Then we see what is the frequency and severity of the risk. Frequency and severity, by frequency we mean how many times in a year that risk event happen. Okay, so if we are talking about a theft in the company, how many times does it actually happen? So you may say that in 100 branches of the bank there was just one instance of robbery in the bank. Okay, so that's frequency. And there may be a small cash theft from the front runners of the bank. So the frequency may be 100 in a year. That's when the severity of the risk come to play. That frequency, that robbery that we talked about, it may have happened once in a year or once in 10 years, but when it happened, it had an impact of $10 billion on the bank. Okay, so the frequency was just once in 1 year or 2 years, but the severity is so high that you cannot just let that risk go. Contrary to that, if you have that cash theft from the customer officer, the frequency may be higher, but the quantum, the severity would be lower. It may be just $10,000 in an entire year. So you may not be concerned about that. So in the risk analysis, you identify your processes, you identify your risk. From that risk, you identify their severity and frequency. And based on severity and frequency, you do your risk evaluation. In the risk evaluation, you talk about if the risk is within the acceptable risk level or not. So we discussed it. There is a concept which is called risk appetite. Risk appetite is something which is the bare minimum risk that a company can adopt. Okay, so for example, if you have invested in the equity market of $10 million, let's say, you may say that we can bear a loss of about $0.5 million. Okay, so once we book a loss of $0.5 million, we will exit that market. Okay, so in the risk evaluation process, we try to map the actual exposure with the accepted risk level, and then we move on to next step of risk treatment, in which we try to decide what would be the risk strategy. Risk strategy is something that we just discussed. Either we would avoid it, either we would transfer it, either we would mitigate it, or either we would accept it. Based on this methodology, once we have done our risk treatment, we will be communicating it to the people who are concerned, who would be responsible for risk mitigation, for risk implementation. And then we would be monitoring it on a continual basis. Remember, risks keep on changing. So the risk that we had in the pre-COVID times, it's not the same. We have new risk coming in. So so monitoring the risk on a continual basis is a critical aspect of risk management process. So this is how we work in a risk management organization, risk management process in any of the organizations. Now let's talk about my final slide, but probably the most critical one, and that is risk control matrices. Okay, so first we discussed what is risk, then we discussed risk management process in detail. Now, what can be the tool that we can use to manage? For example, there's a new startup, there's a small medium business which is critical of how we can manage our risk. So yet again, even if you are a small e-commerce store, the risk mitigation and management techniques would remain the same. Okay, so you will have to go through all the risk management process. You will have to identify your risk. You will have to, mitigate them, decide the strategy, implement it, monitor it. Okay, but one of the tools that is very critical, that is used by all of the organizations, most of the organizations, is risk control matrix. We call it risk control matrix. We call it risk register. We call it risk control self-assessment. There are a number of, there are a number of names to this risk control matrix. But if you are an organization who is just starting to implement risk management, I think risk control matters, something that you can think of implementing. What is risk control matters? Okay, so initially in the risk identification, I told you that the best way of identifying your risk is to identify your processes. Okay, how do you identify your processes? You may have some procedural documents, so you can just take those procedural documents out and you make a list of processes. The more granular your processes will be, the more risk will be identified. The more broader your processes would be, the more broader would be risk be. So obviously, I can imagine that as a small and medium enterprise or a startup, it would be difficult to document those processes into that detail. But if you're a corporate, if you're looking for a corporate or a large institution, that would be a much easier task. So the first step is to identify your processes. Your process should be detailed. It should be step by step. Okay, and just show you a way how it actually works. So once you identify your processes, you have a list of 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 processes, and then in a process, you start identifying your risk. Okay, so for example, your process is the customer comes and submits application to open an account. So okay, it may be an online account, it may be an offline account, it may be for a e-commerce customer. Okay, so what are the risks? What he is opening account for? It may be opening account for doing transactions, for doing business, for getting money, for getting the payments, for funding. There may be a lot of reasons behind it. Okay, but the risk, the critical risk that remains there is the document that you ask from that particular person. So if you are asking the right documents, you are minimizing your risk. If you are not asking the right documents, you would not be minimizing your risk. You would be bringing more risk into the organization. Okay, so the process is there, the risk is there, and how would you make sure? Okay, so what would be the frequency that you would be getting fake or invalid documents? It may be a bit higher, depends from industry to industry. If it's a bank, the probability would be lower because banks are a highly formalized sector. But if it's a small business, the frequency may get high. What is the severity? Severity again depends. If if the core intention of the customer is to do fraud, they may do it with all sort of possibilities, and it may bring a lot of losses also. Okay, so the frequency and severity depends on the customer, on the type of business that you're going through. Then once you identify your critical processes, you have identified, then you identify your risk, you assign your impact and likelihood, then you decide what sort of risk treatment would you be having with this organization, with this particular risk. Are you just avoiding it? Are you just accepting it? Are you creating risk mitigation techniques that would actually bring your risk down? What's your strategy? Okay, who do you report to? Who's the person who are reportable, who should be getting that document? Then last but not least, if we are talking about all of the processes, it is not possible for even a small organization to keep monitoring hundreds and thousands of processes. So what you do let's suppose after all this exercise, you come up with 1,000 risks and 1,000 processes. Okay, you cannot practically implement, and you cannot practically monitor all those of risk. So what you do, you would identify top 50 key risks that you should be monitoring on a continual basis. How do you decide it? Again, judgmental. It would ideally be based on the severity and frequency that we earlier discussed. So if an event has higher frequency and higher severity, then it should be selected as a key risk indicators. And instead of monitoring those 1,000 processes, you would be monitoring just these 50 risks, and you would be making sure that you keep them updated, you keep reporting it to senior management, you keep monitoring it, and you make sure that these key risks are identified on a continual basis, so that you may able to have that comfort that you're managing your risk well. Moving forward, on my last slide, there is a template of risk control matters. So it's a process of a treasury document, of a treasury department in a bank. So as you can see, the columns, the first one is processes, then risk, then control, and then so on and so forth. So the processes, the dealer front office calls to the counterparty, discusses finances. So in the interbank market, bank ABC is having a deal with banks XYZ. So what would happen that the dealer in the bank ABC would be calling the dealer, the treasury dealer at the bank XYZ, and they would finalize the deal. For example, they would say that, okay, I'm purchasing 100 shares of XYZ equity script at a price of $100 per share. Okay, this is a deal. Okay, what is the risk? The risk is the dealers call and execute deal with fake counterparty for fraud. Okay, so the counterparty which is dealing with is just fraud, and it's just fake, and they would be making the payment, but it wouldn't actually be going into a actual valid counterparty. Okay, so what controls do we have? Controls is the risk mitigation aspect which we impose to be able to manage our risk. So the first control, the first mechanism that we have built is that there are counterparty details which is inserted in the system. Okay, so you cannot just insert, even if you talk on the phone, you cannot insert a counterparty which is not there in the system. Then there are dealer limits in place. So a dealer can do only, let's say, $1 million worth of deal in a day. If you talk about the severity and frequency, the impact is 5. It's very high. You can have lose millions and billions of dollars. We have seen cases where there were billions of dollars of trade losses in the treasury. There was this case of Barings Bank where one single trader actually brought the whole bank to bankruptcy, which actually worth billions of dollars. Okay, then you would assign a risk rating, and then you would decide whether it's a key risk or not. So you see that the likelihood impact is high and the likelihood is also high. So you would calculate it as a key risk. You are not avoiding it. You are just mitigating this particular risk, and then you are reporting it to the counterparty risk. You are reporting the dealer's limit. You are doing the approved dealer limits. Okay? And then so on and so forth. So you do this for all of your processes, and you identify the key risk And then instead of all sort of processes, you just use your key risk to manage it, to be able to control it on a periodic basis. So this is basically how you manage your risk. This is basically how you can implement a risk management process in your organization. I had 15 minutes. I think 45 minutes had already passed. We can wait for 5 minutes if there are any questions, if there are any suggestions, you can ask. Thank you for joining in. This is my email address and my WhatsApp number. So if you have any query, if you have any contact, if you want to ask anything, just drop by and we can have a discussion.
Thank you very much, Owais. It was amazing. I have to rewatch it to understand it first. I think that's how it starts. And before I'm closing the conversation and the room, I would like to ask Philomena and Simfung whether they have some questions. Please just feel free to ask, or even if you have some reflection or some, just some opinion or anything that you would like to share, then please do so.
Thank you very much for the session. Just one question. How much is AI being employed in detecting all this risk?
Sorry, I couldn't get you. How much?
AI, artificial intelligence, is employed in the organizations these days because a lot of, as you said, there are a lot of risk factors involved. The only way is that these days is to use AI to detect the risk, because sometimes it's totally impossible to evaluate about thousands of risks.
So basically, there is a lot of development on the AI side. Large corporate, it varies from developing market to developed market. So in the kind of market that I'm working, I'm based out of Pakistan. So there is traction, but there is not a lot of things that have been done here. But there's a lot of scope. Even in the developed market, I arranged a session on AI in the risk management domain. So basically, how you can use AI? Basically, you can use AI to educate the logarithms, to educate the model to make their decisions on their own. That's where AI and machine learning come in. But the problem is that we do not have a lot of data to train them. So there are a lot of criticalities. AI is going to play a significant role in the future. But as of now, in the developing market, the role is on a restricted side. In the developed market, is still in a development stage. It's not like that you would be making decisions out of AI-based models, but it's still there. And I think there's a humongous scope of AI and machine learning coming in the risk management domain in the future.
How do you see the impact of this COVID in the financial sector?
So basically, there are a few risks that have been identified. For example, we did not know that we would be working from home, and it may lead to an additional cybersecurity risk. So the importance of cybersecurity risk has increased significantly. The importance of business continuity planning, which used to be there in the financial sector, that how would we upgrade is if there was an emergency, but nobody had ever imagined that there would be a time where all of the institution would be closed. Business continuity planning broadly used to have a separate place where 100, 200 people would work if there is an emergency, if there is a problem with the head office, with the base office. So the business continuity planning has evolved significantly. Then there is a new risk which has come in place, not in the financial sector, but also in the non-financial sector, and that is of supply chain risk. So we have seen a lot of disruption in the manufacturing market, in the oil market, where there were issues with the supply chain. So supply chain risk is there. Then another risk is human resource risk. So how would you run your organization if your human resource is not mentally capable of managing that stress, managing those things, coping up with the bad times? So that's one risk which is still there hasn't been a lot of discussions about it. There hasn't been a sophisticated framework around these framework, but there's a lot of talks in the market, in the industry, that these risks should be formalized in the face of COVID.
Thank you.
Okay, I'm asking Philomena whether you have any questions. If you can speak, then please do so. If not, then we will close the room. Well, I mean, not closing the room because we were waiting for Katie, but yeah, then we will close the session. Philomena, any questions?
No pertinent questions at this point. Thanks very much for the session. Yep, sorry, unable to log in. There's a session coming up in a few minutes. But I thought it'd be interesting to explore your thoughts. There's a fine balance between the scientific risk and the heart risk. You know, the things that make you laugh and jump and shine and all the things.
That's true.
You know, the balance there is really fine. I don't think there's a clear answer there, but if you have your expert thoughts, that would be very helpful.
I know, basically, as I just mentioned, this human resource side, the psychology side is something that is not usually talked about in the risk management on the harder side. Because there's no way, see, the problem with this harder side is you need a number for anything. So if you want to have a risk management measure, identify the number that you can have of that particular impact. And for the softer side, for the mental stability, for the mental health, for all those things, you cannot quantify it, and that's where the problem lies. So it has significant, room in play, but there isn't much that has been done out in the risk management and in the technical domain broadly.
Thank you. Appreciate that. You know, sometimes it's just really hard to draw the balance between the two. When to draw the line, when not to, and when to go overboard.
That's very true. That's very true.
Good. Any other comments and questions? Simfung, you wanted to say something?
I think while we might not be able to use AI to evaluate the risk, but we can surely use AI to identify risks.
Yes, I think that's also happening. Basically, for example, if we talk about the fraudulent activities. So in the fraudulent activities, we have such systems where if there are any unusual transaction in the system would pop up that, this hasn't been the behavior of this person in last, let's say, one year. And this seems to be a fake or a fraudulent transactions. And then they would be, confirming with the employee. So it has personally happened with me. I was doing a transaction. It was an online transaction and there was some issue, and I got a call from my bank that, you're doing this transaction. This is not how you do it. You don't do this amount of transaction on this time. So what's the reason? So yes, it's being actually used even now.
Okay.
That's all for the time being. Thank you.
Thank you very much. So I will just quickly wrap up. Starting to be tired. So we will wrap up this session very quickly. I will close now the live stream. Can you mention one more time where people can reach you before I close the live?
Yes, just let me start the screen. Yes, so basically, here it is. So my email ID is owais.sidd@yahoo.com, and my WhatsApp number is 0900923343689343. Feel free to contact, inshallah.
Inshallah. Thank you very much, and now I will stop the live stream. Thank you for watching, guys. If you're watching it later, please don't forget, join in the treasure hunt and get the points by referring the sessions, checking up, and sending us feedbacks and aha moments and collecting those points until the end of the year.